Alright guys, I am back again with another video. And in this video today, I want to talk about secrets of Ichimoku. Things that these internet traders are not teaching you about Ichimoku. There's more to Ichimoku than meets the eye. And these traders that are teaching you Ichimoku are not showing you all the aspects because they can't show you what they don't know. So if they don't know, they don't know. They're not showing you something that they need to be showing you. So today I'm going to show you some things that maybe you know and maybe you don't know, but these are the concepts of Ichimoku, the three theories, and we're going to go over them really quickly and discuss them. And in this video, I'm going to give you some primers about each aspect of the theories, but I'm not going to go super deep into detail because I'd be here for a few hours, maybe a few days trying to explain this stuff to you. So we're about to get to it right now, so let's get started. All right, guys, before I get started, first, just want to make sure you do see my disclosure statement here. Please do read it and understand it. Know that I'm not an investment advisor. Anything I do and show you today is for educational purposes only. All right, so please read that, understand it. And once you do that, you may continue. Always before I get started, I like to give some words of encouragement. So I like to give you a reading and a word from the Lord. And today we're reading Romans chapter 12, verse 17 through 19, which states, "Do not repay anyone evil for evil. Be careful to do what is right in the eyes of everyone. If it is possible, as far as it depends on you, live at peace with everyone. Do not take revenge, my dear friends, but leave room for God's wrath. For it is written, 'It is mine to avenge. I will repay,' says the Lord." So Paul now comes to what is a difficult command for many people, including Christians. It's absolutely the example Jesus set for us. However, Paul declares that we must resist our natural human instinct for revenge and refuse to ever pay back evil when evil is done to us. Revenge is motivated by pride. Someone's hurtful actions against us wound our pride, so we want to get even to restore our honor. Instead, Paul tells us to be thoughtful when evil is done to us. He seems to suggest that moments as opportunities to demonstrate that we are Christians and live in Christ and we are honorable people. We cannot display the love and forgiveness of Christ until we have the opportunity to forgive. And when we do, we make a powerful statement that we are choosing to live in service of God instead of service to our human nature. God bless you, my brothers and sisters. All right, so let's get started now with this teaching here. So before I get started, just want to let you know that I'm talking about things that most traders are not aware of when it comes to Ichimoku. So these concepts need to be understood, and I'm going to go over these concepts, but there's no way for me to give you 100% detail on YouTube in this basic video. So it's just a primer and something to help you to understand and know what Ichimoku is all about. So the things they do tell you about is basically they'll teach you about the Tenkan-sen. So the Tenkan-sen, also known as the conversion line, is the highest price plus the lowest price in the last 9 periods divided by 2. And it's regarded as the short-term market level. All right. And they'll teach you about Kijin-sen. Kijin-sen is also known as the reference line. It's the highest price plus the lowest price in the last 26 periods divided by 2. It's regarded as the medium-term market level. So during a trend, the reference line is seen as a dynamic trend line. So Kijin-sen is basically a dynamic trend line for you when the market is trending. And then they'll teach you about Senkau Span Senkau Span A. And Senkau Span A is your leading span 1, and it's the reference line plus your conversion line divided by 2, shifted 26 periods ahead of the current price. It indicates the short-term, medium to medium-term market level. And then they'll tell you about leading span B. which is sync out span B, known as leading span 2. It's the highest price plus the lowest price in the most recent 52 periods divided by 2, shifted 26 periods ahead of the current market price. And then, of course, they're going to talk to you about the Kumo, which is also known as the cloud. It's the shaded area between the leading spans, and it was originally called the resistance zone. So they're going to teach you all these things, and they're going to talk to you about Chikou span, which Chikou span is your lagging span. It's the current price of the market shifted back 26 periods. So they'll talk to you about all these lines, all these 5 lines, and they'll believe that they're giving you all the Ichimoku concepts, and really they may not even know there's anything else. They'll give you some trading setups that they see with Ichimoku based off of crossovers and so forth, and then you'll feel that they've given you a lot of information. But in reality, they've left out a ton of information. All right, so what we're looking at here is Ichimoku trend levels. So first of all, this number here, this line here represents the market price, the green line, trending to the upside. Number 1 here represents a rising market supported by Tenkan-sen, and the market moves down to this Tenkan-sen level. So this first level here is Tenkan-sen. This is the rising market correcting back to your Tenkan-sen level. If a market that corrects at the Tenkan-sen level is seen as a very strong and stable uptrending market. Number 2, this second level, this second thing here represents a rising market supported by Kijun-sen. So it does go past Tenkan-sen, then it drops down to Kijun-sen. All right, this shows that the uptrend will soon reach a topping point. So at this time, Kijun-sen is likely to be supported by the current trend. It's able to support the current trend, and it's said that the market rebounds off of this line, and it's stable at this point if the market's able to rebound off of the Kijun-sen. Then the third thing represents a market being supported by leading span A, the upper limit of the cloud. A deep correction can push the market to the cloud's upper limit. There are many cases where it returns and rises again, but it's recognized that the momentum of the trend is starting to really drastically change. And number 4 here represents a rising market supported by leading span B. This is the lower limit of the cloud, and then rebounding. All right. This is the last level of support for the rising market, and if unable to push higher out of the Kumo, then the upward trend is no longer strong and the end of the trend is taking place. Finally, you can see the market violates the Kumo cloud, closes down below the cloud. It's unable to close back above the cloud again. Therefore, we have a change in direction. We have a market that has changed its position and starting to either find distribution and then probably drop to the downside. Sometimes we find distribution and continue the move to the upside. That's all part of some Wyckoff theories that you may be able to learn from me later. So let's talk about the wave theory, Ichimoku Wave Theory. There's 3 basic wave formations, and they're known as fundamental waves. The first wave is called the I wave. This is a long one-leg move. The second wave is called the V wave, and this refers to a 2-leg move. And the third wave is this N wave, and it's a 3-leg move, and it completes the wave formation. So if it's a bullish N wave, we'll have a combination of rising, falling, and then rising. But if it's a bearish combination, it'll be falling, rising, and then falling. So in the wave theory, we'll try to read the future flow by recognizing the market as 3 waves while finding the I wave and the V wave. All right. So 3 waves of 4 patterns. The basic 3 waves can be classified into the following 4 patterns, which is going to be your N wave that we just discussed, your P wave, your Y wave, and your S wave. And we're going to talk about all those waves really quickly. So in this case, the N waves are divided into the following 5 formations. So basically you have a rising N wave, which is creating higher highs and higher lows. So higher highs and higher lows. Then you have a falling N wave, which is creating lower highs and lower lows. So lower highs and lower lows. And then you have a rising N wave with equal highs and equal lows. This is more so starting to be a ranging market. All right. And then finally, then you have a P wave, which is lower highs and lower highs and higher lows. Sorry. So that would be your P wave formation. And then finally, you have your Y wave formation, which is higher highs and lower highs. So talking about the N wave, this image shows this picture of the N wave, and it's the AB price is greater than the BC price, and the BC price is less than the CD price. All right. The N wave begins with a V wave, and the correction does not interrupt the starting point at A. And the rise of the third wave exceeds the previous high at B. And therefore, we have an N wave and a continuation of a bullish market, and just the opposite for a bearish market. Here we have a P wave. The condition for this P wave is as follows, basically. AB price range, AB, is greater than the BC price range, and then the BC price range is greater than the CD price range, and then the CD price range is greater than the DE price range, and so forth. So it continues to get smaller and smaller and becomes a P wave. Let me draw this out for you. This is how it looks like if you put lines on it. And it looks like a P wave, and this would be the market moving from the upside, and this would be your P. Also resembles a flag. All right. Also resembles a pennant triangle. And that's what some people know these as. The next thing that we have here will be your Y wave. All right, so the Y wave condition represents this. Your A, B is smaller than your C, your BC. And then your BC is smaller than your CD. And then you would have another leg that extends below C, and then another leg that extends above D, and then maybe another leg down. So then you would have something that looked like this. And this would be known as your Y wave. All right. So in chart formations, this is known as a broadening formation. And it's also called an expanding wave because of the way it expands on the outer portion. All right. So the Y wave always begins with a V wave. All the waves begin with a V wave pretty much, in which the correction from the rise violates the starting point at A. The rise of the third wave exceeds the previous high at point B. All right. So now you understand that wave formation. And here's an S wave. This is an intermediate wave. And basically you can see the S wave outlined in the blue here. What happens is basically almost like we talk about our fractal bounce. And that's what I know this as, basically. All right. It's called an S wave to convert the resistance to support. So we have the market here creates this resistance point where the market drops down, violates the level, which is resistance, now turns the support, and then finds support here and then pushes off of the level. Therefore, you have this S pattern here. To me, this always looks like a Z pattern, and I would think it would be a Z, but I look at this as a fractal trade, a fractal bounce trade, or a S wave trade. And you'll hear me talk about that often, very often. All right, so the N wave trend continuation. So the state in which an uptrend or a downtrend continues can be regarded as a series of N waves, as you can see here. All right, let me get my drawing tool. As shown in this image, you can see the series of N waves. All right, series of N waves. If there's a 5-wave formation, there's 2 consecutive N waves. Let me erase this and show you that. So this is a 5-wave formation. 1, 2, 3, 4, 5. And we have a series of 2 N waves. One right here, this green. And then another one here, this green. All right, so we have a formation of 2 N waves. Let me delete that. So if there's a 7-wave formation, there are 3 consecutive N waves. So we have 1, 2, 3, 4, 5, 6, 7. We have 3 consecutive N waves. Here's your first one, this green here. Here's your second one, and here's your third one completing right here. So you have 3 consecutive N waves. This is important for you to understand, because when you start looking at the market direction, looking at structure of the market, you always want to know the structure of the market. And counting these waves and seeing these waves is going to be very vital for you, because I'm going to explain to you when we get to the top of this wave what you may start to see. So then we have a 9-wave formation, and there are 4 consecutive waves. So this overall, this black lines here is a total of 9 wave formations with 1, 2, 3, 4 N waves. If this market were to move again, so suppose we moved a little bit higher, then we dropped down, and we didn't close below this level, but we never closed above this level. What we would be getting into would be something like this now. And this could be like our P wave. And then at that point, we either break to the upside or to the downside. A lot of times at the top of this trend, you're going to see distribution where the market sees this level. So we would find main levels to be this upper level here and this lower level here. And this would be where the market would be contained. And we would find this area of distribution here. And finally, maybe the market violates and starts to move to the downside. All right. So the trend is not known from the first and second waves, but the moment the third wave is completed, the current trend will emerge and let us know the direction of the market. Because again, you have to violate this level to form this 1 leg, 2 leg, and then this third leg, which forms your N wave here. So now you're looking at your structure here. So again, when this market moves, your main thing is, if we get through here, we have one full leg up, which is going to be our 1 wave up, or 1 N wave up, and then the market drops to the downside to correct. At this point, it either has to break this high, or eventually it's going to break this low. This is all market structure that you need to know. And if it can't break that high, or maybe spikes through and then moves back and closes to the downside, then that's where you get that liquidity grab that we talk about. And then the market drops back to the downside. This could be, again, distribution. Now, again, you can have distribution where the market finds distribution and then again continues its upward move, or else you have distribution where the market then violates to the downside. It all depends on the market structure. These main levels are going to be very vital for you. So you can always see this in a trend. You can look at any chart and see this. All right, so the same thing would be in this next move. We moved higher. But if we weren't able to violate this level, then we would start to get into some kind of form like this. That could be a Y wave for us, right? And therefore, we might see the market break to the upside or the downside. So that's where you get into these. You have these fundamental waves, and then you have these other waves where you have no directional bias. All right, with these with the Y wave and the P wave. So you have no directional bias, and therefore you need to wait for the wave to complete. But usually they happen at the top or bottom of a trend. Those will be the main things that you look for. So looking at that in this aspect, the N wave trend change, it occurs when an uptrend turns into a downtrend, and an intermediate wave appears along the way. So we have this, the black line is going to represent our main trending market, the direction we're going. This is going to be the wave within that trend. This green line here is going to be the first N wave. But then we failed to make another N wave because this blue line here cannot violate its high, which means we're not violating this level. So it doesn't violate the high, and therefore starts to form what could be a P wave at this point in the market, right? Because if we can't violate this level and we're here, and then we continue to do something like this, again, we're starting to see a P wave, or maybe we see a Y wave if the market makes higher highs and lower lows, then we would have that Y wave formation. But in either formation, it's going to be a non-biased move, and we have to wait for the end of that to create itself, and then we could determine which direction the market is going at that point. But usually when you get that, it's after a nice move, and then you get to a topping point, and then you'll start to see those formations take place. All right. So here again, you could see once that P wave was developed, all right, then we started to see the N waves to the downside develop. All right. So again, this P wave would have caused pretty much like a ranging market, and then we would have got into this move back to the downside. And that's how the market does. That's the market structure. That's the main thing for you to learn. You want to understand market structure. It's the main thing to know when you're trading with any market, period. Ichimoku or not. All right, so now we want to talk about Ichimoku level theory. The level theory is to predict the levels at which the third wave reaches the first wave and the second wave from the third wave to the wave theory. So the idea of the Ichimoku price observation theory, also known as calculated values, comes from the idea that there's a center for the price movement. So Ichimoku concepts are made up of half price lines, and this is also a process of pursuing the center of price fluctuations, right? So the calculated value is based on the theory that if you find the center of price movement, you can predict the subsequent movement. The four calculated values are the N calculated value, on the idea of placing the center of price fluctuation in the middle of the second wave, the E calculated value centered at point B, the NT calculated value centered at point C, and the V calculated value is centered at point B in the sense that it will rise from point B by the amount that it falls from point B. And I'm about to show you exactly what I'm talking about. So in this case, we're showing here the N calculated value. So for the N wave calculated value, the CD rise cannot exceed the AB rise and stops at the calculated N value. So we get that calculated N value by saying this distance from A to B, which shows here as 295, will be the same distance from C to D. D will be our target, which would be 295. So here's how you would use this concept. So suppose you were trading this support level right here, right? The market, this was a resistance point at one point, but the market made this move, corrected it, and then corrected itself back to this level. At this point, you get into the trade long, and as you got into the trade long, now once the market moves off this level, you have 3 points. You have point A, B, and C. Now, if you have 3 points, you're able to find point D, because all you have to say is AB, which is 295. Let's say this is 295 pips. We just add 295 pips from that point C, which would give us the target of N calculated value. All right. We have the V calculated value. So it's the larger BC portion, the smaller value of C. So what it basically is saying that this BC move to the downside, if we take that and add it to the top of B, so let's say from B to C is 189 pips, let's say. If we now add it to this level, we can then say that we're going to move from this point to this point 189 pips. So how you would use that, again, two ways here you can use this. So let me show you the 2 ways you can use this. Again, one would be the support level, where the market broke resistance, came down to support, you got into your trade. Now you have 3 points, and you would look for your entry. So now that you have 3 points, you can figure out this level, because you would say this is 189 pips. I'm going to add 189 pips to it, which would give me this target up here. So therefore, I'm going to move from this trade all the way up to this level. Or else you could say now certain traders don't trade this level. Let's say this trader traded this breakout here. So now he can find his target still, because he has 3 points, A, B, and C. All right. But now he just adds B and C to make to the top of B to find that D target. So now when he enters this breakout trade right here, he now knows where his target is, which would be the V calculated value. So now he has the N value located, he has the V value located, and now he knows two levels where he can take his profits when he's trading. Then we have our E calculation. This is the farthest calculation. All right, the rise from C to D will be greater than that AB rise, because what this rise is, we're saying that this rise is double AB. So whatever AB is, you're going to add it onto the top of B. Last time we added AB to the bottom of C. This time we're adding AB to the top of B. All right. And when we add it to the top of B, we just doubled. So this was 295 pips, let's say. It moved up 295 pips from A to B. So now we're going to say, when our target is looked for, we're going to say it's going to be at D, 295 pips from point B. So how this would be used is, again, twofold. Let's say the trader finds this resistance point at B. He goes here. The market pulls back. He finds a level to get into the trade. He trades long at this point. He can now add these two levels and put his level on top of B and have that D target. Or the trader could trade the breakout of B and still know that he's going to trade to the D level up here, which is the E calculated value. All right. These are how you use these levels. And then the final level is basically a market that is not going to violate this B level and therefore starts to get into a range. And now we have fluctuations. So let me show you basically what this is. It's showing that how you find this level is you take from point A to point C. So this we have to have a move off of the C level to understand this, right? And then now we're saying, okay, the market needs to violate this level to continue this trend. Well, what happens is the market's unable to violate that level to continue this trend. So the market gets into some kind of fluctuation. It could be this kind of move here, which would be basically your P wave, right? So that would be your P wave formation. It could get into that kind of formation, or else it could start to get into this type of formation where it goes higher and it does this. That would be our Y wave formation, right? And then it can also do this at this point. If we came back up to here and we just range in this area, a flat range market. But when you can't violate B, then you know there's issues with your trend and with your trade if you're trading to the upside. All right. And so therefore you're not going to reach these other values of E and N and V, because now NT failed to violate this level. And I always tell traders, when you get into a trade at level 3, I always trade, I call these levels 1, 2, 3, and 4. So level 1, 2, 3, I always trade at level 3, always. And then I shoot for level 4, which is one of these values right here. All right, so these values will be lined out, and I shoot for one of these when I get into my trade at level 3. I always want to get past level 2. If I can't get past level 2, then I know my trade is in trouble, and I usually take my profits once I see I'm not able to get through that level, because I know the market's going to be in some kind of fluctuation. So that's basically what these values are when you're looking for at the market. So now we're going to talk about time theory just a little bit. So one of the characteristics of Ichimoku is that it places great importance on time. So by understanding the theory of time, you can use Ichimoku more efficiently and more effectively. So the theory of time is the concept of Ichimoku, which states changes in the market price, such as the trend of the market, the period from the high price to the next high price, and the period until the market reversal, are formed by a certain number of cycles of numerical combinations. All right, so Ichimoku has numbers that we look for the market to shoot for, and these are these numbers right here. These are the numbers that we're looking at. So you want to learn these numbers and know these numbers. The first three numbers are our base numbers, and they all come from everything that we talk about Ichimoku, the main concepts. 9, Tenkan-sen, 17, 26, Kijin-sen, 26 periods ahead, 26 periods behind. And then we have 52. This is 51 here. But also look at these numbers. These are going to be the numbers that you're going to be looking as target numbers or change date numbers. Okay? Days where the market's going to change. So when we look at this thing, so the numbers above the chart indicate that these indicate this is where the next high is going to take place. And then the numbers below the chart indicate where the next low is going to take place. So as we go back in time, we see the first high that was created on May 9th right here, which would be this one. This was created on May 9th, and the next high on June 23rd. All right, it took 33 days for these to make this cycle from this high to this high. That's an Ichimoku number, right? It took 33 days to create these highs. And so we always allow 1 or 2 day difference, all right? And then the next high is predicted on August 9th, right here. That's where we predict our next high. 33 days later. Boom. 33 days from here. And this was 33 days here. So that's equal values here. All right, and then our low prices was made 37 days apart. That's not an Ichimoku number, but it's 37 days apart. So we're looking for the market to do the same thing. We're saying this low is going to be created here 37 days later, which would be at this point. All right, so now we haven't reached this day yet, and we have a target level to reach, to look for. We know which day that the market may change. So let's say this day is going to be June 10th or something. Whatever this day would be, we would know that that would be the day that we see the market create a low, and then we would look to shoot for the move to the upside. All right, and then that's when we would start to look for our high value 33 days later. All right, this is a little more not detailed, but it's a little more detailed to it than what I'm telling you. I'm giving you some basic information about the time theory here, because it's really one that you have to really get deep into. So we also have equal numerical values. It's top to top time and bottom to bottom time, and they repeat the same numbers for a certain period of time. This is called your equal value numbers. So equal numerical values also come out as basic numerical values. So you see what it's saying here is point A to B is 17 days, and point B to C was 17 days or 17 bars or whatever. We're also saying, so this low now we're saying point A to B, A to C. So this would be A, B, C, and then D. We're saying A to C was 26 days and C to D is 26 days. What this is actually telling you is that this I wave right here, this is your I wave. And you're going to get now another I wave, should take the same amount of time. That's what that one is telling you at that point. But it also can go like this. This V wave took 26 periods, and now we're going to look for our overall N wave, which would be the N, one I wave, just adding an I wave, which is also going to take 26 periods, equal values. All right, that's what it's telling you. So looking at the equal value numerical value, we're saying first wave equals second wave plus third wave. First wave, which is this I wave, equals your second plus third wave, which is a V wave. All right, and we're also saying our first wave, which is this I wave, equals our third wave, which is this I wave. We're saying that is going to be equal. So equal, we're saying maybe it's 17 bars here, 17 here. Let's say we're 26 here, we're 26 here. And what we're saying here is that this first wave, which is a V wave, So it's saying the first wave plus the second wave, which is the V wave, equals the third wave, which is the I wave. We're saying that this is 31 and this is 31. So equal values define these targets. So in the concept of building a chart, you're going to look for equal values or your Ichimoku numbers to find target days of change. All right, where the market changes direction. A change can be even not where it exactly changes direction, but it could just be where it increases momentum. You have a bigger move that increases the same move. So at this point, this image shows the kind of image you're trying to capture for a day of change in 3 waves, okay? So we look to count the number of candlesticks from the point where the rising and falling change in those 3 waves up, down, and up, and search for the next turning point. Okay, understood? So we're going to count in 2 ways. We're going to count with the base numbers and the equivalent numbers. So it said that the method of determining the change date is to combine the basic value and the equivalent value to determine the appropriate change date. While comparing them, we should discard one when it is not necessary, adopt the other intensively, and decide on the correct change date. So all we're trying to find, guys, is like a change date. So we have all these things to help us now, because now we have, let's say we have our values up here. So we have our E value, we have our N value. Actually, that would be my V value, and we are N value, and we have our V value. So let's say we have those values here. Let's say that we're saying from this point to this point, from here to here, took 26 days or 26 candles or 26 periods. Now we know that to get to this point could be 26 periods or 31 in that area. So now we know when we get to this level, how many days it could take us to get to this level, to get to this level, to get to this level, and when that day is going to occur. So we can look at the day that this may take place and change and determine what the market's going to do. Now, you would then, if you see the market not reaching your value here and it starts to correct, it doesn't come all the way back here, because you definitely don't want to come all the way back there, but it depends on how big your trade was here. And then you can't get through this level and you start to see some kind of fluctuation, then I would start to worry and maybe take my profit. But if the market can continue, makes a small correction and continues to violate, now we would be able to know that we may reach our E level or our N level or whatever level we're shooting for, hit that target on the day of change that we determine based off of these numbers here. 26 could be 26, all right, 31, and so forth. So it would be those numbers. You look to mark those numbers, and I'll get deeper in this with another video later. I just wanted to get this stuff to you. But basically that's going to be it. So what we want to understand is wave, time, and price are not separate theories, but they are one in themselves. So if you look at the waves, you'll notice that each wave is likely to be a basic number. You can also see that when you find bullish end waves and bearish end waves, that third wave is often one of the above calculated values. Our calculated values are the levels that we're looking for. So then time theory determines when trends will change. Wave theory looks at the shape of the price movement and determines what it will do next. And price range observation theory, you can determine the target value of the price. So I have this stuff all in a bigger course that I have on my site, but I'll give you guys a lot more information concerning these concepts, and we'll go over these one by one and look at them in more thorough concept. All right, but today just wanted to let you know and let you see that when people talk to you about Ichimoku and you get very excited about it, they're usually just giving you the basic information about Ichimoku, and there's way more to Ichimoku than what they are probably teaching you. So just wanted you guys to be able to see this and have this and understand it. So hope it's helping you. And until next time, guys, have a great one. God bless. So long.